Hey everyone, Jordan here with CoveredCall ETF Investing, your central hub for deep CoveredCall ETF data. In today's video, I'm excited to share the first month-over-month data within the CoveredCall ETF AllStar tracker. For those who don't know, on January 1st of this year, 2024, I launched this Google Sheet which combines the info from a fund manager website and the price performance data from places like Google Finance, Yahoo Finance, and merge everything into an easy to use data sheet that you can filter through and help make yourselves more well-informed, confident income investors. And that's what's important to me, not just for myself, but to be able to share that with all of you. So as I said at the very launch on January 1st, is that month over month, I would be not just updating the tracker, but I would also be expanding it, which I'm going to get to in a moment here, to make it a more powerful tool month over month. Okay, as far as I'm aware, this is the only thing out there for CoveredCall ETFs that's updated on a regular basis and includes all the info that I'm about to share with all of you. It is available if once we go through this video, you want to try it out for yourself. In the pinned comments down below in the description, or you can find it just on my homepage, a link there to my Patreon. For me, it shows up as $9 American a month. Don't know why that is, but for you guys, if you click on it, it's about $13 a month. Even if you just try it out for a month, you'll get access to this month's tracker, and even if you cancel beforehand, you'll still have access to next month's tracker as well. But this is actually where you can find the February tracker that we're about to go through, and I also have some other stuff in here as well. The main focus right now in the Patreon, at least for Q1, is to really refine how I collect the data, enter it, and just get it out to you guys on time, on schedule, and make good on those promises of those updates that I kept. So for February, the main promise was distribution history and adding .u funds like you see here, and .b funds, which they're like, say, Cuddle B as an example. Those were the main ones, but I also sprinkled in a few extra ones as well. I added a couple tabs to track assets under management and a yield tracker tab as well. So we're going to go through all of those big updates, and then we'll kind of go line by line just to see what kind of value we can extract from each column. We have dividend streaks to go through. We have dividend increases month over month to go through. Dividend increases from inception to basically to this month to go through. We'll be speaking about leverage. We'll be speaking about moneyness and portfolio coverage. All that good stuff will be here. This will be a really awesome tool. I really encourage you guys to try it out. There's about 36 members actually in the Patreon. Whether you've joined as a paid member or as a free member, really, this will save, I'm sure, a lot of you guys a lot of time. But as always, if you want the most up-to-date information, go to the fund manager website yourself, as this info is current as of the last trading day of each month. So in this case, that will be January 31st. For the first tracker I put out in January, it was good up to December 29th. That's when most of the price performance data is taken from. So let's go through some of the big changes with the tracker here. As you can see down below, I added a tab for distribution history. So for all the Canadian funds now, they're basically all entered in. There might be a couple small stragglers. I know TD, RBC, Moldova Hill, I think they have one, so I'll probably add those in eventually. But at least for the tracker, I just wanted to add in all the funds from the big seven, which are BMO, Brompton, CI, Evolve, Hamilton, Harvest, Horizons, and Purpose. So one of the nice things with this is that, hey, you can actually track when were the first distributions paid out. Whoops. And another cool way of extracting data from this is what you can do is you can highlight the entire row and just see how much has been paid out. You see a sum of $13.29 for ZWE. And head back to the AllStar tracker, go to ZWE. Its price is $20. So it's basically almost paid out. Well, okay, it's paid out, call it, I don't know, 65%. 65% of its share price. So that's, in a way, that's your like distribution return since ZWE came out. So that's kind of a neat little way of extracting data from here. You can, as you go through, you'll notice a big blank spot. This is just simply because CI only pays out quarterly. So if you go through CI here, you'll notice, yeah, that they only pay out quarterly. This is also a good spot to check out what funds are new. So you can see HPYM, HPYM.U, HPYT.U. These are newer funds by Harvest that just came out. So there is no distribution as they came out and were launched in January. Two other notable ones were these single stock ETFs by Purpose, expanding their slate to NVIDIA, Microsoft. I swear, these guys got to do an all-in-one, because as we're going to touch on in the AllStar tracker, some of the best performance has actually come from these single stock ETFs that Purpose has put out. And I think a lot more people would be interested in something like that. I think Purpose is, in my mind, they're kind of more of a niche CoveredCall ETF provider. Yeah, they have many other funds, but at least in the CoveredCall space, more niche, right? Because they got Bitcoin and these single stock ETFs, right? They kind of mirror, in a sense, they kind of mirror the Defiance ETFs of the world, the Yield Maxes of the world, except their funds are structured much more differently than those funds, where you actually do have access to the underlying. They only write something like 50% on the portfolio. They have a little bit of leverage. So an all-in-one for these guys, I think, should happen, and in likelihood it probably will. Okay, so we'll go over to AUM. So I put this in because this is going to help us understand which funds are kind of in, they're kind of in sinking territory, meaning all these funds that we look at, are they going to be around for 50 years? Doubtful. So we want to keep tabs on that month over month so that we can actually extract the info to tell us what funds might actually be in trouble. But we also want to be able to assess the overall health of the CoveredCall ETF space. So one way we can do that, again, this is month over month data. We can go into monthly change, and okay, again, these funds I just had entered, so they weren't on the first month's tracker, which was from December 29th for January 1st when I launched. So we'll go down to here. So again, a great tool that we can understand which funds are seeing the biggest inflows. But not just that, as you see a lot of green here. We can compare the green to the red and assess the overall health, at least for this tracker, the overall health of inflows into CoveredCall ETFs here in Canada. So the biggest winner so far is QQCL, going from basically $9.5 million all the way up to $14.3 million for a change of plus 50.94%. One thing that I was kind of surprised by was this bond ETF by Evolve, almost not even talked about. I think the big ones, a lot of the attention has been put on HPYT for its massive yield of 15+%. Same with H-Bond by Hamilton, often talked about a lot, and the bond ETF by Evolve kind of just scuttled to the side, but also seeing massive positive inflow here at plus 44.39%. That's an awesome number for Evolve. Not to be outdone, HPYT not far behind at positive 31.12%. Inflows going from over the course of 1 month of $158 million up to 207, almost hitting 208. Now, what's actually kind of curious is to see this big mix of just different sectors. We got technology, we got bonds, we got energy, we got healthcare, we got all-in-ones, more technology, diversify. So it's kind of a mixed bag, and I think a lot of that just simply has to do with, as always, if you're an income investor, it just simply has to do with yield And who's offering the biggest yields? Well, we know QQCL is, QMax is. Bond, on the other hand, I'm not too sure. Curious, what is Bond offering as far as a yield? That I don't know. Where's Bond here? Right here, 10.55%. So with its forward yield. So basically meaning this column here that's in bold, it's, as the note shows up here, its forward yield just means your current distribution times 12 months divided by the share price. And that's how you get forward yield. Okay, so what other kind of notable changes do we see here? Yeah, again, it's kind of a mixed bag, kind of going slowly through here just so you guys can, eye it up for yourselves. Now we're kind of getting into we're getting into much smaller territory here. So let's just check out what saw outflows. Now you can see outflows weren't as significant as inflows. See a lot of, minus 0.11% minus, a lot in the 2 to 4% range. EBNK seeing the biggest drop. So we can see that not as much outflow as far as inflows. That's not a shock. CoveredCall ETFs are quite popular right now. And will they continue to be popular a year, 2 years from now? That story has yet to play out. But at least for now, we can at least track it. And again, month over month, what I'll do here is you'll always see December, you'll always see January, you'll always see February, you'll always see March, but I'll add columns in for 3-month change, I'll add 6-month change, and then I'll add year-to-date change, along with, of course, monthly change as well. And that way we can, again, assess the health of all these funds and how they're all doing, right? Because if you're seeing month over month and 3 months negative, and continued outflows, and you combine that with, I might even do a separate tab just for 3-month average volume, and you can see that volume is whittling away, or maybe it's stagnant. I think these are two good metrics of understanding if a fund is potentially on the chopping block. Doesn't mean it absolutely will be, but at least you can assess it and take that into consideration whether you pick it up or not. Okay, so at least with AUM, for now, I think this will be, again, powerful data for all of you, and especially over time once we can add in all these other columns. The other bonus I added in here was a yield tracker as well. So why did I want to add in a yield tracker? So as income investors, a lot of the value in whether we pick up a fund or not is, of course, the income portion, the yield portion. How much is it yielding? But we also want to look at how much has it changed over month. And just like AUM, I'm going to be adding in other columns to track the change over the course, month over month, over 3 months, over 6 months, year to date, probably 1 year. I'll probably do eventually, as I keep doing this, 1 year, 3 years. So right now, let's go through the monthly change from the start of January all the way till the end of January. Why Tesla? Biggest massive change that we got going on right there. So I'm no doubt with that info alone, I know you guys are probably picking up why Tesla, with a commanding positive 38%, not to be outdone. But in second place, another strong change with TLF. TLF is we're going to get to this one, actually pretty interesting once we get to the month over month distribution increase change, because this ties directly into BMAX. Okay, so we got change there. Again, funds that are kind of under 10%, this channel really isn't talking about. I mean, if it gets within that 9 to 10% range, I think it's more interesting. When I get one-on-one calls or questions through emails, people ask me, they're not really asking about the 6% yielders or even the 8% yielders. It's basically the 10% plus stuff. But nonetheless, it has a yield change. If you like Brompton, you like their you like their CoveredCall ETFs, you can pick that up. Again, other kind of more significant changes would be, I guess, base, kind of on the slightly more significant lower end at 7%. This fund probably starts getting really interesting once it hits 10%. I think it hit maybe 9.55% at one point during January. Now everything else is starting to become a lot less significant, 1%, 2% change in distribution. So again, I want to make this very clear. When you see 2%, it doesn't mean that the yield has clearly gone up 2%. Like, just look at the change here. It just means that, right, there is a 2% difference between 7.4 and 7.54. It's a 2% just distance between one another. Again, not much change here, month over month. Now let's get into which ETFs have declined in yield over the course. Again, nothing really significant. I'm not really going to touch on the 1%ers, the 3%ers. You can certainly do that for yourself, but again, it's like 11.79, 11.47. Not much to talk about there. It's more a case the 7 and the 9% range that are kind of more interesting to discuss. So ZWEN with the biggest decline in yield, from 9.77 all the way down to 8.87. And then of course we got BRKY and Y Google. By Purpose Investments, seen no doubt. Price performance has a lot to do with this. When you see something that has declined in yield this much, price performance is no doubt the culprit for that. I hold HTAE by Harvest. I have 50% in my portfolio. And again, HTAE has actually done pretty good for just a pure technology fund. It has gone from 10.7 all the way down to 10.22. So it's almost exiting out of that range of, like, I want yield, and I certainly lean growth with CoveredCall ETFs. But once it's out of that 10% range, I think I'll just sort of hold off until we see a bit of a correction. No doubt every year there's going to be some form of 5 to 7, potentially 10% correction. It happens almost every year, and then it ends up rebounding. But when it happens, that remains to be seen, at least here in 2024. Okay, so now that we've been through the big changes, let's go through line by line, and we'll filter everything. We'll look at, of course, forward yield first. That's why it's in bold, is because we are interested in yield. What are some of the biggest yields from this month? So let's go through that. Oh, actually, you know what? I should show you guys. I should show all of you. I'm not able to click on it. So basically everything that you see here is in a view only mode. And that's how I want to look at these funds, is what you would see, or what you're seeing here is what you will eventually get if you join the my Patreon. But if we want to include a filter, I'm gonna have to put this down here for a moment. If you want to include that, you're just going to have to go to data. Well, you got to click on column number 2 there. Go to data, go to filter view, create a filter view, and then there we go. Creates a filter view. So now we can filter all that good stuff. Okay. So let's go through yield. What are some of the highest yields that you could pick up right now? So coming in at number 1, Tesla, as we kind of just saw in the yield tracker, we can pick up for 26.46%, insane for a single stock ETF. ENCL not far behind, not to be outdone, 18.74%. And I believe the day before making this video, I think it actually hit 19%. Bank, which also uses leverage. This is now the highest yielding financials CoveredCall ETF for this month, with 25% leverage. BKCL, not too far behind. Same with HMAX. Doesn't use leverage, but is about 1.24% out from those other two financial competitors here in Canada. UMAX. Often not really talked about, but this is a fund I do have at 13.69%. If you want access to telecommunications, railways, of course, things like pipelines, your more traditional utilities like Emera and things like that, then pick up. Would be a great fund to pick up, because hey, we need electricity, we need energy. So in my mind, UMAX not going anywhere. To me, it's the most notable utilities fund out there. And we can even, just as an example, as we you know what? I'm not going to deviate from that. Let's just stick on yield for a sec. So as we kind of head down the list here, we see which funds are also kind of in that territory of what might be dropping out of the 10% plus range. But we see even here, a single stock ETF by Purpose is just out of that 10% range. H bond by Hamilton just squeaking out of the 10% range. But of course, if you're picking up H bond, say versus HPYT, you might be using H bond for more of that potential growth component, as it has 50% coverage at the money, whereas HPYT can write up to 100% coverage on the portfolio. So as we kind of go through the 9%ers, this is again interesting territory. Some of these funds probably want to get back up into the 10% range. I'm looking at Ubase. I know you're trying at least to represent the mining aspect, the mining sector, I should say. And then as we kind of head below 9, again, these are not necessarily funds that are often talked about here in the income investing community. No doubt they a lot are popular in the sense of like bigger AUMs, but as far as like social media, YouTube content, not often talked about. We're kind of more or less interested in the 10% plus range, right? That's why I have, that's why that's in the YouTube banner here. Generate 10% plus passive income, just to signal, hey, this is what this channel is about, 10% plus. Doesn't mean we won't talk about the stuff that's under 10%, but anyway, let's keep moving right along. 7%, actually, what's the lowest yield we got for CoveredCall? ZWT by BMO. And I can assure you, nobody's talking about ZWT, but ZWT on a performance standpoint over the last year and a half, at least the year, has done incredibly well. And we'll kind of get to price performance data in a little bit here. I'm not going to talk about trailing 12-month yield. In my mind, if you're looking at what yield you can pick up today, and that's why forward yield is the most important. So we'll skip over trailing yield. Let's go over into volume. Let's actually check out who actually had the biggest volume on January 31st. So we can see here the biggest we can see that the biggest daily trading volume was ZWE. So BMO goes from ZWT in bottom of the barrel in yield to highest volume. This is important. Liquidity is important and shouldn't be overlooked. That's why there are these two columns. 3-month average volume, so basically the average daily volume, and then we have just the day's volume from January 31st. If you are picking up a fund that has seriously low trading volume, could be in the tens, it could be in the low hundreds, there's a potential you could end up trading more because the bid and ask spread is quite large. And I know that has happened to people where they thought they were paying one thing and ended up paying way more because it just wasn't liquid enough. So keep that in mind when you are picking up these funds. But for January 31st, we got ZWU on the throne for highest volume, not to be outdone by HMAX. Another very popular CoveredCall ETF yielding in that 15% range with 149. And as we go down the list here, let's kind of, I'm more interested. Let's go see what's at the bottom. What's in that territory of could be serious. You could find some serious liquidity issues. So things like BLOV, EBNK, HBFE registered nothing on the day. And then you kind of got these other ones, again, low hundreds. And what I'm interested in is if any of you out there are buying these funds and are having no issues with picking up these funds at low volumes. I've done it in the past. I remember there was this real returns bond ETF I invested in for a couple months during 2021. I just needed to park some cash somewhere. And this thing had serious low volume. We're talking again, in the tens, and I didn't have an issue with it. But that doesn't mean that depending on the platform, you won't have an issue. So throw it down in the comments if you've actually had issues with trading volume. All right, let's go over to Average 3-month volume. So ZWB, kind of no surprise there. ZWB, I believe, is the biggest covered call ETF in Canada. And again, it's just equal weight, the big 6 Canadian banks. And in second spot for, actually not to mention ZWB, its AUM is massive. It's like, I forget what it is. Like, anyway, it's in the billions of dollars. HPYT, now month over month is, again, it was, I think, in the number 3 slot last month's tracker. Now it's in the number 2. Quite the popular fund, no doubt about it. HPYT, for people, especially people who are into covered call ETFs, tend to be retired, near retirement, and to pick up something that's fixed income related to get you that into that 15% range. I think HPYT is going to be a staple in this spot here. Again, if you want sort of more price appreciation with your fixed income, you can pick up something like H-Bond by Hamilton or Bond by Evolve. So as we kind of go through this list here, we got a lot of there's not much else to see. In this range, 27,000 units, pretty liquid in my opinion because let's see, what have I invested in? Like HYLD.U on a monthly basis, this is just dripping inside my wife's spousal RRSP. No issues there at 6,000 units average traded every single day. So no issues with that. What else do we got? Again, 3,000. I don't think you're going to see much issue with that. It's just once you kind of get down into this smaller category. I notice, here's the thing with Brompton, and this is only something I kind of saw only recently, is that now a lot of their funds are trading within that under 1,000 range. Now, how much does that actually affect BMAX? Because all those funds are within BMAX. I can't see BMAX here. Not sure where here we go. So BMAX, significantly more liquid than its individual underlying assets. And I own BMAX, and I'm just happy with the continuous distributions that they crank out, and almost no changes there despite the ages of some of these investments. But just something to note for those who are invested in BMAX, a lot of the underlying are kind of in this range of, like, they're some of the least illiquid technically on the tracker here. All right, so let's go next over to, I'm not going to really focus on 52-week low, 52-week high. Let's kind of move along. If you're kind of interested in, you have your RSP account and you're looking for funds, maybe there's just nothing out there on the American stock markets that you're kind of happy with, but maybe there's something in Canada here you would like to invest in US dollars. So this, for at least this month, this could be really handy to use. So let's just take out Canadian funds that trade in Canadian dollars, and let's look at just funds that trade in American dollars. So we can see here a few funds that do just that. I invest in HYLD.U, like I said, in my wife's spousal RRSP, and there's a bunch of other funds here that trade in American dollars. So maybe whether it's just to kind of hold some American cash for now while you try to look for that American fund that, or stock or ETF, whatever it might be that you're interested in, this could be a parking place for investing in a fund that maybe you're familiar that trades, again, in US dollars. So let's add back in the Canadian currencies, and then we'll kind of move along to performance here. Okay, so we're now looking at price performance. So with price performance, let's see what was the biggest winner of the last week. So you can see BTCY, biggest winner at 7.7%. So a lot of purpose. CI had a couple of big winners. Wow, purpose really coming through here with the big winners over the past week. A little bit of harvest. Now let's see, again, only noticeable changes. Who are the biggest losers? There we go. That's something I can change later. This is also a good spot for me to go through and just recognize what might be, just needs like a small little color change. Let's see, what do we got here? Whoa, that can't be right. USCC minus 26%. So as we go through this is something that I will look into. Minus 26%. Okay, I'm gonna have to look into that a little bit further because that can't be right. Anyway, ignoring that for now. Tesla Y, no surprise there, and everything else was kind of more moderate. Okay, let's go into 1 month performance. Who had the biggest 1 month performance out of everything? 1 month, BRK was the winner. We got Y Google at 7.71. Who else? Let's check in on some HTA.U, another big winner for this month. HTAE.B. HTAE gained about 4.71% in this month. And let's kind of check out some of the ones who didn't perform as well. I know, no doubt, USCC for whatever reason is going to be at the bottom. So Tesla Y, USCC, that just doesn't seem right. What is going on with USCC? You know what? I'm just going to kind of cut out here and try to figure out what's going on. USCC, we can see on January 29th, it didn't decline by 20. It's been rising ever since. Okay, so that's just a weird glitch in the in the performance data. So I'll have to dig into that and figure out why the data kind of came back as that. Anyway, let's look at 6 month volume. Let's check that out. So at 6 month volume, again, BTCY, of course, with the spot income ETF coming out, this is going to be this is the biggest winner, no doubt there. Let's actually check on some of the all-in-ones, how they've been doing. So again, HTAE, if you're into tech, what are some of the actually leading tech ones? We got TXF, 10.75%. Again, and we're kind of getting into sort of modest. Again, this is just price performance. I want to reiterate that. Everything that we're just looking at is simply just price performance. No total return has been incorporated into this. So let's go down into negative territory here. Over the last 6 months, who has suffered the most? We're seeing a lot of things like financials have been affected. A diversified Canadian fund has suffered. Why Tesla down 37.65%, of course, upping that yield. What else do we have in here? Travel, real estate kind of down. HMAX kind of down in the last 6 months. We're not going to do year to date because that's basically 1 month. So let's do price performance over the course of a year. So over the course of a year, price performance wise for a CoveredCall ETF fund, man, purpose. Again, that's why I was saying a little bit earlier, these guys got to do an all-in-one because you're going to attract a lot of just conservative investors who want that diversification, or that's one of their guardrails that they've put in place for funds that they've invested into. I think you're gonna see awesome price performance from an all-in-one as well. And this is just no surprise here. We got purpose at the top of the heap, 3 of the top 4 positions. And then we even have some more purpose within the top, whatever that is. That's the top 16. Okay. So 1 year, 55% for Amazon. And then we got Bitcoin, we got Google, HTAE, again, a fund that I'm invested in. I didn't pick up HTAE at the right time. So like the price performance wise of HTAE is over the course of 1 year is, yes, 42%. I probably picked this up back in October. I'm up price performance wise about 17%. So still amazing. I'm happy with that. Naturally, yes, I wish I got into it a little bit sooner. But as you can kind of see a pattern here. This is typically not what you would necessarily expect with CoveredCall ETFs. They are the critics and people who might try to dissuade you away from these funds would say that these funds do not grow, but that just simply isn't true. Even over the course of 1 year, we are seeing really awesome price performance, and a lot of them do yield 10% plus. Now we kind of get into territory which is kind of more what I would expect. It's kind of just more stable, which is what I'm trying to achieve. A stable portfolio with growth over time if possible. So this is where you're going to see a lot of your all-in-ones or your more diversified sector funds in here. And that's exactly what we see. Sector funds, all-in-ones. And they're kind of more, again, they're more stable, whereas these other ones at the top, more niche and are either single stock ETFs. So the more concentrated a fund is in something, again, if it's an all-in-one, more potential for it to have rocket fuel, but also more potential for it to be an anchor and to fall, depending on the sentiment of the market. So if we're seeing green across the board, usually it's those kinds of funds that are probably doing the best. But if we're seeing red, those funds are doing the worst. Okay, so let's go through who is doing the most lousy out of everybody. ZWK. Oh man, I actually had ZWK at one point during last year, but I only put like $1,000 into it, and it generated, I think, $9 a month for me. Ended up selling it I had something like 4 financial sector ETFs. Now I have 3, 2 of them Canadian, 1 American. The other one I have is Call, just for that American bank exposure. So we got that. And then we got a bunch of these sector CoveredCall ETFs. Financials have been beat up. So you can see BKCC, HMAX, Call, and ZWK kind of at the top of the heap for that. Still trying to recover from last year's financial meltdown a little bit. Now we kind of get into, let's do 3-year price performance. So who are the biggest winners over the last 3 years, price performance wise? ENCC, bit of a surprise there, but nonetheless, ENCC price performance. This one might be a bit of I would go to the fund manager website just to check on this one, only because ENCC has gone through a bit of a change over the last year and a bit. It's constructed entirely differently, new ticker name, new underlying investments, or the weighting of the fund of the underlying assets have changed. So and it went from variable distributions. It went from variable distributions to stable distributions. So I wonder if there might be something there that might have, I don't want to say the word manipulate, I think that's a wrong word, but that some kind of mechanism has maybe changed this to be more than maybe necessarily what it is. I'm not saying that if for sure it is, but some for you guys to dig into for yourselves if you're interested enough. Again, 3-year price performance, we're seeing green across the board here. No total return whatsoever. What are some other kind of notable ones in here? We're seeing a lot of Harvest, CI. Now for the all-in-ones, the all-in-ones haven't been around for that long, so you're not going to see any of the HYLDs in here. You might see HDIV has almost been around for, I think, 3 years. But there again, of course, anytime you're in the 0 to call it the 5% range over maybe a period of 2 to 3 years, you're kind of in that stable range. Price performance, that's where ideally I'd like to be, especially if inflation kind of mellows out at say the 2% range. Then hopefully the fund price-wise over a 3-year period can grow 6% and keep up with at least inflation, bare minimum. Then we check out some of the ones that have declined the most. We got real estate over the last 3 years. HGR, which I believe is the only CoveredCall fund in Canada, is down 31.42%. And let's see, again, BKCC down about 10% over that period of time. Now we get into total return. What are we seeing from total return over the last 3 years? So again, this is price performance with dividends reinvested. We see ENCC again at the top of the heap. A couple of funds in that 100% plus range. Other funds that are kind of more notable in here. I kind of want to go down to the stable range just to see what is hanging out sort of in that 0 to 10% range. So again, kind of just more sector funds. The bigger the bigger funds, now you're not seeing the biggest drops that we were seeing in just price performance wise. With total return, HDR again, still negative 17%. With call and ZWK and the financials position being down, even with that total return over the course of 3 years being down almost 8% roughly. Price performance wise for a lot of these funds, TLF up about almost 100% over that period of time. Price performance wise, man, it's impressive. For covered call funds, a lot of green when it comes to just regular price performance, not a lot of red. So kind of debunking a lot of the ideas about covered call ETFs, that these things just simply go down over time. But we also are starting to see more red at the 5-year point. We certainly are. So it'll be interesting once we click on total return, how that affects. There, let's go like that. So price-wise, we're seeing a lot of the older funds, which I consider kind of a little bit more, they're a little more out of date. So things like CI, Horizons has gone through some changes. So it'll be interesting with Horizons. With a lot of their funds, they're now stable. They've changed a lot of the makeup of their funds. So over the next 3 years, it'll be interesting to see how these harvest funds actually change over that period of time. Looking at a CoveredCall ETF tracker, 3 years from now versus say this one in particular, just to see how those changes were affected. And then at the bottom of the heap, we got price performance wise, we got call, unfortunately, right at the very bottom, price performance wise. But if you want that US banks exposure, not a bad fund to pick up, especially for its yield at, I think it's somewhere around 13-14%. Okay, total return over 5 years. Not too many funds have been around for 5 years. A lot more of those efficiently operating funds have been in the last, either 2023, 2022, even 2021. The last 3 years have really seen more efficient funds developed. But nonetheless, total return over that course of time, HTA.U is on top of the heap with 161%. Go down the list, lots of green to see there, and only 2 funds in negative territory. So we got HDR minus call and Hubble in that range. Okay, so now that we've kind of been through price performance wise, again, check it out for yourselves so that you don't have to just slowly go through the video. Again, $13, I don't think it's going to break the bank, and you'll have access to 2 trackers. So as we kind of round out the video here, we'll look at information from the fund manager website. So we have the ex-div and payout dates. So you can see when you can expect these payouts in one easy location. Payout frequency, monthly. There's only a couple that are quarterly, and that's just all the CI funds. Management, we can go through some of that. What are some of the highest management fees? I guess no real surprise here with the Bitcoin and Ethereum. A lot of harvest ones in that 0.85 range. To me, the more typical range is 0.65. To me, that's what I tend to see the most, and you'll kind of see it here, 0.65, all the way down, 0.6. So what are kind of the least expensive? Now we have a lot of these zero management fee, but that's simply because these are usually ETFs that hold other ETFs, so you're not going to get double charged. You'll get charged on the ETFs that are held within inside of all of these funds. So make no mistake, HDIV, BMAX, HYLD, these are all funds I hold. They're all going to say on the manager websites that they are 0%, but again, the underlying have all the management fees built in, so you won't get charged. Okay, so we've been through that. Let's go through management expense ratio. This is usually the combination of management fee, trading cost, and leverage expenses if there is leverage involved. So it's all of the management operating fees all in one place. So let's go through that. We'll go through the most expensive all the way down to the least. So right at the top of the heap, I'm kind of not surprised. BMAX 2.53%. Its leverage is the most out of any cover call fund at 33%. So much more leverage expenses for BMAX to pay out. Next up is HHLE. Yeah, you'll see a lot of the harvest funds probably at the top here, the sector harvest funds in that 2.5% range. We got HYLD at 2.4%. Now, HYLD, its management fees will decline. Heading for March's update, HYLD will have a significant, like, what you're going to see. Oh, actually, you know what? I changed it for this month. Just because they had an announcement right before I made this video that they have now gotten rid of all the third-party fund managers. So now everything inside of HYLD and HDIV right here is now all within the Hamilton product umbrella. And no more Global X funds, no more Harvest funds, no more JP Morgan funds within HYLD and HDIV. So that will go down, and we'll have to wait until the new MERs come out for this to be adjusted. But I suspect it'll be interesting to see, do these funds dip below 2%? Again, it will be interesting to see that. What else do we have here as far as management fees? Let's go down. What's dipping below? I'm curious to see. So the cheapest leverage fund that you can actually get is Bank at 1.7%. Wow, that's actually pretty, with 25% leverage. You know, this is actually the first time I'm noticing that. So, and you got an expense ratio, or you got a management fee of 0.6. So Bank actually, especially for its yield, it's able to, you know, you get certainly more yield with that lower management fee. So, hey, kudos to Evolve for just figuring that out. Now, I think Bank, if you're looking for a financials ETF and you don't mind the leverage, this is now a series fund. I would give this a good look, you know. And I know HMAX and BKCL and BKCC are those other really very popular Canadian bank funds, but this now, I think. And Bank is up there. Let's make no mistake. Bank is up there with BKCL and HMAX. But with that management fee expense ratio being as low as it is, like, boy, no wonder that they have the top yield. It's because their MER is so low. So, hey, Evolve, kudos to you guys. Credit to where credit's due. Doing a good job with that. However you're able to do it, keep it up, because you just might get an investor out of me. Let's see, what are some of the cheapest MERs that we got going on here? Let's go 0.52. Wow, that doesn't seem right. Okay, just when I thought I thought the cheapest leverage out there was Bank, we get 25% leverage on all of these funds. So again, a surprise to me. So okay, so they charge 40 basis points for the management fee, and the leverage and trading expenses are 0.52. I mean, I just congratulated Evolve ETFs, but Purpose, I don't know how you're doing it. There might be something. This is something I'm going to double check, and I'll correct if it's off right away. But that is shocking how that could be that low. Now, does it have to be with the number of shares within each fund, or how many units are available, and that's why it's so low? I don't get it. Okay, so that being said, let's move over to portfolio coverage and moneyness. So what we'll do is we'll get back to organizing everything by fund manager, just so you guys can see sort of the general strategies of each fund manager. BMO, they do up to 50% on the portfolio out of the money. That's why their yields are typically a lot lower, you know, in the 6 to maybe 7-8% range. If that Brompton, the most liberal of all the fund managers, they could do up to 100%. We never really know where they're at, so they could do up to 100%. It could be at the money, out of the money, in the money. They really have no. What it seems like is there's really no rules essentially in place. I'm sure I'll back up. I'm sure there's rules in place, but it gives themselves maximum ability to pay out that constant distribution, which Brompton is known for. Okay, CI, they do up to 25% at the money. Again, with those quarterly distributions and variable distributions, CI is not, again, it's not widely talked about. They have been around for a long time, make no mistake about it. They are pioneers in the Canadian covered call ETF space. But I think with a distribution schedule change, go monthly, and so if it goes monthly and it goes stable, I think CI then now enters the conversation of serious funds to invest into, because a lot of them have been around for a long time, have that history. So you know what, if there is somebody from CI that watches it, I really hope you guys do this. I would love to talk more about CI, but it's just with that distribution schedule and the variable payouts, and the funds can typically be over 10%. But again, I don't get a lot of questions about CI just because of that deterrent alone. People want that monthly income. I know CI's got a lot more other stuff going on with funds, so I just wonder, covered calls are probably not necessarily the main focus for them. Okay, now let's go into Evolve ETFs. They do typically 33%, up to 33%, allowing more growth in the fund to participate in market action. Out of the money. Usually that out of the money is, in their ETF facts, I believe it was like 2 to 5% out of the money. The only exception is bond here. They do up to 100%. Now we'll get into HMAX with their yield maximizers ETFs. So typically their funds up to 50% at the money for, of course, more yield focused funds that generate those higher monthly income returns. Let's see, then we got Harvest up to 33%. Oh, you know what? Actually, back up. With Hamilton, there is, what is it? SMAX here is up to 30%. So that's the only noticeable change. Next month's tracker will include the 4 other newer funds that are going to be launching in early February. Those will be included. What else do we got here? And some of those funds actually are, up to 30%, or I think maybe one was up to 20%. So allowing for more portfolio growth and market participation. Harvest, again, you got 33%, and then out of the money, at the money, as far as their strategy is concerned. Then we got, what do we have here? And with their bond ETFs, it's up to 100%. Horizons up to 50% out of the money, and with the combination of some of their leverage funds, you're seeing some pretty great yields from BKCL and CNCL, ENCL, and also EQCL's up there with, I think it's 11%, something like that. QQCL is up there as well. Those are definitely the more talked about funds of late, since they have come out back in October, I think. And then you have a Purpose with sort of up to 50% out of the money, and then you got the leverage on those single stock ETFs. Okay, so that's it for moneyness. AUM, we've kind of already been through that. We can look at all the leverage funds that are in Canada. BMAX we touched on. A lot of the Harvest funds have about 25% leverage. Evolve has that one fund bank with the 25% leverage, and Purpose. Whoa, what happened there? And then again, Horizons, we just touched on them, higher yielders with the leverage. One of the nice things with the leverage, if you are going to be holding it long term, is it will improve price performance. Again, if we go through a bad spat of red, then, well, it's going to magnify the losses. But over time, we know markets tend to go up. So if you're confident that markets will go up over time, then leverage will be your friend in that regard. And also along the way, it'll also up your yield as well. So I think you get the best of both worlds there. Especially if you're confident in using leverage. I plan to hold. I'm 34. I'm going to be holding these funds for a long time. No issues for me on that front. Okay, as I said, we have a couple more columns to go through. We are well into this update. This is way longer than I thought it would go. I will promise to ideally make it shorter for next time. What else do we got here? Inception dates. We won't go through that. First distributions ever paid out. Actually, you know what? We missed something here. Dividend streaks. Let's go through some of the biggest dividend streaks. here in Canada. We see TLF at 152 months. This isn't years, obviously. These funds have not been around since the Civil War. So yeah, 152 months. I thought it would be easier to track like this, months, simply because a lot of these funds haven't been around for that long of a time. So I think it's just better to measure a streak in months versus years, or else everything would be 1111, maybe 2222. Not necessarily the greatest info there. So what are we seeing here? We see Harvest kind of dominates the top position. We got that one Brompton fund. We got Brompton, and yeah, Brompton certainly litters the top, but Harvest is certainly all over the top here. And then we kind of get into a range where Brompton kind of rounds out. That's why I say Brompton just is a steady payer, especially if you have all those funds within BMAX. BMAX would most likely be your most consistent payout. Whereas all these other funds by Harvest, just keep in mind that a lot of them all are also the .U funds, .B funds, as you're seeing here. So let's kind of go down to the funds that have either just not paying out anything at the moment or have seen a cut. Blob, I want to highlight this one actually. This one was in the top for a while. It had something like 63 months and then it had a slight cut, and now it's basically back to square one. But other funds, a lot of the CI funds, no surprise here, they're quarterly and they're variable. So their streak's kind of just measured in quarters, I would say. And the best you might get out of CI is maybe a growth streak of 3, call it, at best, right? So you have one CI fund, it has a distribution streak of 2, meaning, the most recent distribution from CI on that fund was just simply higher than the previous one from September when that payout occurred. Okay. So now we're kind of rounding this out with distribution month over month change. Let's go through that. You see here January to February, and this column right here measures that change. We got TLF with a massive distribution increase, going from 9 cents up to 11 cents for a 21.75% increase. And then I'll say kind of far behind, but still impressive, ZWT, another tech fund. They're both tech funds, raising their distribution. BMAX raises its distribution. Why? Because it holds TLF, so it gets a 4.2% bump. And then QMAX, again, another tech fund, lots of inflows into tech. Price performance of tech funds have done really well. So a lot of the distribution increases have come from these tech-centric funds. And then we got UMAX, just a slight increase here. Since last July, its distribution has gone down 1.66%. Nothing to worry about there. I'm not concerned. It's a fund I hold. Same with HMAX. Again, I hold it. Slight increase, 0.06%, down 5.62% since basically, I'll call it a year since it's been out. But overall, nothing else has really changed other than we'll go to see distribution decreases. So pretty much everything else status quo month over month. Hamilton and Brompton with H-Bond and Blob. Blob just could not hold on. If it could only just stay a little bit stable, it would keep that distribution streak alive. I think it would have been worth it. For Brompton, probably don't care as much because, hey, no one's tracking that stuff until now. I'm tracking it, so I'm aware of it. Again, 63 months. I think that would be a worthwhile streak to keep going. The only real notable one is ZWEN here. Going down 8.7%. So that's a big, massive decrease in distribution. Again, ZWEN not necessarily, let's see, BMO CoveredCall Energy. So it's a little bit newer. Energy is volatile, so not surprised necessarily by the changes there. So last but not least, we're going to go to changes over the course of since inception of these distributions. So we see, again, TLF.U, not TLF, is right at the top of the heap, with 246% increase since it first paid out, which is in September of 2019, which is impressive.